Hi, good afternoon, everybody. Welcome to our third installment of a Benjamin Tal webinar about the economy. Benjamin, it's always great to have you. And I see that you're sitting in front of the brand new CIBC logo.
It's the new one, yeah.
Story to that. That's a rebranding of the branch, and I understand that you're very proud of that, and we congratulate you on.
Thank you very much. Looks nice, I think.
Okay. Anyway, many of you have been watching us for previous webinars. To give you a little bit of a historical background, this is the third of a series, and it's interesting. I think we could trace a very dramatic 2 years. The first one was at the very onset of COVID. And at that time, we just discovered what Zoom was. We didn't have webinars. It was a regular Zoom presentation. We didn't even say it, believe it or not. But at the time, we didn't even know what COVID was. Benjamin had a long dissertation about the zigzag economy, U recoveries, V recoveries. And we sat back and watched what happened. The second time we had an installment was almost exactly a year later. Well, not quite a year later, it was in November, it was a year before. So that was on November 17, 2020. It was exactly a year ago. It was after the US elections. And Benjamin did some very startling predictions. Just as a recap, let me show you a couple of them. And Benjamin, you'll be able to comment on them as a segue into your talk today. Rena's not sounding.
I will make a wild assumption here that Biden will end up being the president, despite the fact that Trump is not agreeing with that. And I will also suggest that Georgia, the election there, you will see a situation in which the Republicans will take the Senate there. Therefore, you will have a divided government. This is a reasonable assumption at this point.
Okay, well, that was the first prediction, but your forte is economics. But let's see the second one.
However, we are getting very good news from the vaccine front. You're all aware of that. I'm not going to get into it. We have 2 vaccines already, over 90% effectiveness. We have 7 more vaccines coming in a very advanced stage. So the issue will not be if we have a vaccine. We are going to have a vaccine. The issue will be logistics. How quickly you can, make sure that everybody gets it very quickly.
Okay, so we're up to a 50% batting average. That's great. The third clip, I think was most fascinating because, quite frankly, it was widely covered in the press. And I think it would be a very introduction to our speech today. And let's play that one.
Listen to this. This is amazing. This is the first recession ever that income is actually rising. Not only is it rising, it is rising at the fastest rate ever. Today, listen to this. Today, Canadian households are sitting on no less than $90 billion of extra cash in their deposits and savings accounts. $90 billion of excess cash. We have never seen anything like that. This cash will be redeployed into the economy the minute we see the light. Some of it will go to real estate. This liquidity bubble is going to be utilized in a very aggressive way. That's one of the reasons why I believe that the economy will rebound quickly in the second half of 2021 because there will be enough ammunition to generate this kind of activity.
So Benjamin, again, it's an honor having you. Benjamin, as many of you know, all of you know, is the Deputy Chief Economist of CIBC World Markets. He is a very, very well-known speaker at economic events. He's widely published and reported in the press. It's a great honor for us at Lanterra to have you here and address our audience. Benjamin has a set of slides, and Karina, who's helping me on the technical side, will be putting that on. So Benjamin, what is the future going to look like? And before I get off the screen, I would like to tell our listeners that we will have a question and answer period at the end, and there is a question and answer button on the bottom of your screen. If you type in your questions, I will try to pick questions that I think Benjamin would have insight to answer. So Benjamin, again, it's a great honor, and we're all looking forward to see what you have to say.
Thank you very much, Mark. It's a pleasure. So I will stick to economic predictions. I will stay away from predicting Senate races in the US. But overall, I think that it's very important to understand that the nature of the recovery and the nature of this recession is really impacting your business in a very significant way. And we have to explore why, and we'll do it in a second. Clearly, we have to talk about this tug of war between COVID and the economy and what it means in terms of the trajectory of the economy over the next 6 to 12 months. You know, government assistance, it's coming to an end. What does it mean for the labor market? All those people that got money not to do anything, are they coming back to the labor market? We'll discuss. And then, of course, we have to discuss the elephant in the room, and that's inflation. And how much sleep should we lose over inflation with major implications for your business? And then, of course, what it means for interest rates. We know that the Bank of Canada and the Fed are talking about raising interest rates. So we'll see where it takes us, how rapidly interest rates will be rising, what will be the terminal rate, and again, how sensitive is the real estate market to higher interest rates. We'll have to discuss. So a lot to talk about and see what makes sense and what doesn't, and then we'll take it from there with the Q&A and the discussion. Let me start with the tug of war between COVID and the economy. The WHO is now starting to be worried a bit about a situation in which they will be running out of Greek letters to name the next variant. Really, officially, they said so. So they have to think what will happen. Namely, they're thinking about more variants. Namely, it's not over. You look at Europe, Eastern Europe, the number of cases starting to rise. So we know that it's not totally over, although we would like it to be over. We also know one thing, and that's very important, that COVID and the Delta variant is a vicious virus. Now, what it means one thing. It means that the next variant will have to be like super variant to outdo it. So when I talk to some people in the field, they're telling me, actually, that's good news, because it means that the next variant will have to be very, very effective and very strong in order to outdo Delta. And Delta is not one wave, Delta is waves. You look at what happened in the US, it came in the South, then Florida, then the Northeast. In India, it came and went. Even India, where the vaccination rate is relatively low, it's almost over. The average duration of Delta is about 2 months, and we are basically at the end of this trajectory. So this is something to consider, and basically a positive spin in a negative situation. So we know now that what will impact government policy regarding restrictions is not the number of cases as it was in the past, but the situation in the healthcare system, what we call the hospitalization rate. So let's go and see what makes sense and what doesn't in this environment. So let's go to the first chart, please. And you can see something very, very interesting. This is the dark days of early 2021, the second wave. This is the peak of hospitalization rate. Now look at Canada, the gray line, very, very low compared to other countries, including the UK, Israel, the United Kingdom that were ahead of us. And you can see that their peak is 3-4 times higher than Canada's peak. Now, what does it mean? How come Canada is peaking at such a low level? Is it a good thing or a bad thing? Unfortunately, it's a bad thing because you go back to the headlines in early 2021. It's not that the Canadian health system was fine. We were basically at a breaking point at a very, very low level of hospitalization rate. Why? Let's go to the next chart. And you can see why. This is spare capacity of acute beds per capita. Canada is the lowest in the OECD with the exception of Mexico, the lowest with the exception of Mexico. If this is not a wake-up call to inject money into the healthcare system in Canada, I don't know what it is. Because clearly, when you're supposed to operate normally at 85% capacity, like any other country in the OECD, we operate at 97% in normal times. You have COVID and you exceed capacity overnight. That's more or less where we are. Now, this, of course, has major implications, especially on the economy. Let's go to the next chart and see what I mean by that. This chart is basically the conflict that is defining this crisis, the conflict between lives and livelihood. And you can see that for a given level of infection, for a given level of hospitalization, the Canadian economy was much more restricted than the US economy. And that's the number one reason why the US economy was able to outperform the Canadian economy during COVID, because we were shutting down the economy more aggressively, more quickly, because our level of capacity in the healthcare system was relatively low. And if we have a fifth wave, that will be the case as well. It will trigger economic policy, a more restrictive economic policy, much faster. The threshold is much lower for Canada, given our situation in the healthcare system. So that's something to take into account. Let's hope that we will not get to it and it will not be tested, but that's the number one reason why the US was outperforming Canada so far. So that's the tug of war between the healthcare system, COVID, and the economy. Now, let's go to the next chart and see the most important factor regarding the economy, and that's the labor market. And the good news is that despite the fact that economically speaking, the US was outperforming us, when it comes to the labor market, Canada is doing better. Now, there's all kinds of reasons to believe that the numbers are a bit inflated in Canada, but overall, it's actually good news. As you can see, the level of employment is almost back to where it was in 2019, so we will take it. However, this is the headline numbers that you see in newspapers. What you want is to get a bit deeper and get a sense of what's really happening in the labor market, because that's something that will impact your business, again, down the road over the next year. So let's do that and see where it takes us. Let's go to the next chart. And the next chart is giving us the asymmetrical story of this labor market performance during COVID. First of all, although we are back to 2019, we are still missing about 250,000 jobs because population went up over the past 2 years. So we are still down, but we closed the gap with 2019, we'll take it. All the jobs created during COVID were public sector jobs. Healthcare, education, we know the story. Salary employees, the private sector, basically back to 2019 level. Look at self-employment. It went down overnight during the recession and did not recover. And the question is why? And maybe the answer, maybe, is that if you pay people to stay home. They will stay home. And that's exactly what we have seen with many self-employed, especially those people who are being paid very little. So at a low wage part of the interval, the wage interval, we see self-employment going down dramatically, reflecting government assistance. And the big question will be, what happens when it ends? And that's basically happening now. How many of them will come back? We'll know soon enough, but I suggest that not all of them will come back. We have seen it in other countries, in other states in the US that are ahead of us in terms of ending the assistance, and only a portion of people that were supposed to go back to the labor market are back. And that's why the vacancy rate in the labor market is at a record high. People are not coming back. Something to think about when we talk about inflation. Let's go to the next chart. And that's basically the distribution by wage. And you can see, and that's something that we indicated already last year, and it's happening more and more, that this is the most asymmetrical recovery ever in Canadian history when it comes to the wage distribution. Basically, almost all the jobs created were high-paying jobs. In fact, the one that is down, it's between roughly 30 to 60,000, significantly down. So we are seeing a situation in which this asymmetrical nature of the recession is something that has a lot to do with the performance of the housing market in Canada over the past 2 years. We will get into the housing market later, but just let's discuss it for a second because I think it's important to understand. People are asking, how is it possible that the housing market has been on fire despite the fact that we were in a recession and COVID? And the answer is this chart, the asymmetrical distribution of job creation. You see, all the jobs that were lost among young people, low wage individuals. Most of them were renters. For home buyers, potential home buyers, COVID was not an issue financially speaking. In fact, the opposite is the case. They are better off because their savings rate went up, as we discussed in the previous presentation with this mountain of cash that people are sitting on. So you have a situation in which a huge segment of the population was unimpacted by COVID, financially speaking. So if you think about it for a second, you get the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. Usually when you have a recession, interest rates go down, but also the unemployment rate goes up and it's broadly based, so job insecurity is out there, people are not spending, clearly they are not buying houses. But when your job is there, it's secured, your income is there, and interest rates are in the basement, that's the opportunity that you were waiting for. And that's why there was this sense of urgency to get into the market. That's exactly what happened in the housing market, is still happening. So this is the environment, the virus, the economy, the labor market, where we are. However, clearly, we must discuss the most important issue impacting us at this point, and that's inflation. Now, granted, if you are under the age of 30, you don't even know how to spell the word inflation, but we have to recognize that it's happening. So let's go to the next chart and see what I mean by that. This is GDP. As you can see, in real terms, in the second quarter, GDP was down. But in nominal terms, namely after inflation, it's up by 8%. And given the fact that government revenues are based on nominal GDP, Trudeau is much richer than he thinks. And even in Ontario, we have seen the budget deficit half of what it was supposed to be because of this huge increase in nominal GDP. Why? Because of inflation. So the key question is, how much sleep should we lose over inflation? You read the newspapers, you know that it's controlling the agenda at this point, the inflationary fears, and we have to discuss it. Let me start by telling you one thing, and I'm very clear about it. Nobody, Nobody knows where inflation will be 6 or 8 months from now. Nobody. And when I say nobody, I include the Fed and the Bank of Canada in that nobody. Nobody knows. People are pretending, but nobody knows. That's the reality. So the question is how you deal with it and what kind of policy you activate given this uncertainty. In order to do so, we have to go deeper and see the source of that inflation and try to guess how sustainable it is and to what extent it is all COVID related. Let's go to the next chart and start this exploration. First, everything, 100% of inflation that we are seeing now, 100% is COVID sensitive. Basically, goods and services that are related to COVID. And when we woke up, the gates are open. That's where you see the inflation happening in services and goods that are linked to COVID and that were shut down, and the pent-up demand is being utilized, leading to inflation. That's one thing. The second chart is the wage aspect. That's the next chart. And we are seeing the wage aspect of COVID. Can we go to the next chart? Or yes, thank you. And you can see that the wages are rising. That's going back to the issue of people coming back to work or not. Now, go to a restaurant, go to a hotel, even in aviation, you cannot find people. You simply cannot find people. In the US, people are quitting like there is no tomorrow. The vacancy rate is at a record high. Regardless what you do, you cannot attract people. How do you try to attract them? By paying them more. And until recently, many young Canadians were sitting at home, collecting government money and watching their future wage rising. And the big question is, how many of them will go back to the labor market the minute you don't have this check coming every 2 weeks? And I believe that some of them will, but again, you go to some states in the US that are ahead of us, and you see that not all of them are coming back. And there is another issue, and that's people over the age of 55. Especially in the US, we have seen a situation in which many of them decided to exit the labor market during COVID. And I'm telling you, if you are over the age of 55 and you decided to exit the labor market during COVID, you are not coming back, which means that this shortage of labor can be with us for a while. And when there is shortage, people are paying more, wages are rising, and that's inflationary. And when you have wages rising, you don't see them going down anytime soon. So that can be inflationary for another year, something to take into account. And then you have the next chart, which is supply chain. Listen, economists have many, many faults, but amnesia is not one of them. We all remember the 1970s. And the question is, to what extent the supply chain issue that we are facing is basically what we have seen in the 1970s and the stagflation of the 1970s with lower growth and higher inflation. And I suggest something very simple. Comparing today's situation to the 1970s is not only wrong, but also irresponsible. This is not the 1970s by any stretch of the imagination. Back then, interest rates were in the sky. Today, they're extremely low, too low. Back then, the baby boomers were consuming like there is no tomorrow. That's not the case now. And back then, the level of debt was much lower than it is now, which means that the sensitivity to higher interest rates was not as high as it is now. You cannot compare today's situation to the 1970s. However, the big question is it supply or demand? What's causing this issue in which you have to mortgage your business to get a container from China? What is the number one issue here? Let's go to the next chart and discuss. This is durable goods in the US, the chart to the left. So you can see that you're still way higher than you should be. Services are almost back to where they should be, but goods are 20% higher relative to the trend line. which means that in a very short period of time, overnight, economically speaking, you got this demand boom. People buying like there's no tomorrow. Why? Because you click a button and you get what you want, or at least you're trying to get what you want, but you're ordering it. So you get your exercise bikes and all the things for the house. We all know the story. And it's still there. It's not going down dramatically, which means that you get this demand shock, 20% overnight. And I'm saying this kind of huge increase in demand can challenge a supply chain system that is normally functioning. And this, of course, is not a normally functioning supply chain system. It is sick because of COVID. You don't have enough drivers, you don't have enough people to deal with the containers. We know the story. So you have both things happening at the same time. You have demand rising dramatically, reflecting this amount of money in the system, and you don't have the supply to provide and to make sure that this demand is satisfied. And that's why prices are rising. No question about it. So it's both. It's demand and supply. What's common here? It's all COVID related. Take COVID out of the equation, and this will disappear tomorrow. And that's why the Bank of Canada and the Fed, until very recently, was telling us, don't worry, everything is fine. This supply chain issue will die soon. But with Delta, and things are moving, but not as quickly as we want them to move, COVID is still with us. And as long as you have COVID, you have this. And therefore, the narrative from the Bank of Canada and the Fed is that it will take longer than we thought. It's not permanent, it's COVID related. And let's hope that by spring of next year, COVID will be endemic as opposed to pandemic. And therefore, we can look at it and we can go back to normal, we hope. And if that's the case, this gray line will go back to normal, the red line will go back to normal, and then you will have the supply chain able to deal with the market. But in this environment, it's a shock coming from the demand side, and that is met with a sick supply channel system. Okay? So that's more or less where we are. So if you sum it up and you go to the next chart, you can see why it's so important, because the market is getting nervous. The market was expecting that by now the supply chain issue will not be an issue. And now all of a sudden the Bank of Canada is telling you, you know what? Remember I told you that it would be over? We were just kidding. It's not going to be over anytime soon. It will be well into 2022. And the market said, yes, in this case, I'm adjusting my expectations. Today, the market is expecting the Bank of Canada to move no less by 6 times in 2022, starting as early as March or April. This is a very aggressive market pricing. Until recently, the market was talking about the Bank of Canada moving in 2023. Now they're talking about early 2022, 6 times. That's a very aggressive set of expectations coming from the market. And the 5-year mortgage rate is smelling blood and is rising now, reflecting this kind of expectations. That's more or less where we are now. Granted, what the market is expecting doesn't mean that that will happen. That is just market expectation. And the question is what the Bank of Canada will do. And this is very important to understand when you discuss it with clients about interest rates, very important to understand. The Bank of Canada and the Fed, as I suggested earlier, they don't know where inflation will end up. And there is an issue because inflation is a lagging indicator. So when you wait and wait and wait and wait, you will be behind the curve. And what is the most important asset of a central banker? The most important asset, it is its credibility. And if you tell people, don't worry, be happy, inflation will disappear tomorrow, and it doesn't, you lose your credibility. So the Bank of Canada is facing a credibility dilemma now. If you wait and wait and wait, you risk losing that credibility and being behind the curve on inflation. If you start early, you basically show that you are in charge. So when I communicate with the Bank of Canada, and I see them very often, unfortunately, I tell them, listen, start early, no issue here, but you don't have to go 6, 7 times in 2022. No need. Absolutely no need. You can go 2 or 3 times. You will establish your credibility, but you won't shock the market because, and that's very important from your perspective, what is the enemy of the real estate market and the economy in general? What is the enemy? The enemy is not rising interest rates. The enemy is rapidly rising interest rates. Because every economic recession over the past 50 years was helped, if not caused, by a monetary policy error in which central bankers raise interest rates way too quickly and shock the economy. So I say, take this, cut it by half, and continue moving in 2023. I see the market ending up taking rates to about 2% in 2 years, 2.5 years, from 25 basis points. So it's a significant increase, but slowly. That will be the right thing to do. If you move to 2% over the course of breakfast, you will shock the economy. So the key issue here is not how high interest rates will rise, but how quickly they will rise. And I believe that the Bank of Canada gets it. I believe that the Fed gets it. They would like to avoid repeating past mistakes. So a reasonable scenario, they will start in April, maybe July, depends on the COVID situation, and they will go 3 times in 1 year, and then another 3 times another year. Take it slowly. That would be the most reasonable thing to do. And the market, I think, is mispricing how aggressive the Bank of Canada will be. Now, given that, and given the fact that we are talking about interest rates, we have to discuss the real estate market and the impact of higher interest rates on this interest-sensitive sector. So let's go to the next chart and discuss. We got today's number from Korea. The numbers are up again. We have a monthly sales, so in terms of units, at about 54,000. Just to remind you that before the crisis, the average was about 40,000. During the crisis, it went up to about 70,000 per month, and now it's back to 50, 55. So it's down, but it's still 10, 15,000 units higher than it was before the crisis. That's one thing. It will get even stronger than that over the next few months. Why? Because of higher interest rates. And you ask, how is it possible that higher interest rates will lead to higher activity? It's always the case, as you know, because whenever people smell higher interest rates, whenever the Bank of Canada tweets about higher interest rates, the minute the market is thinking about that, people get into the market to make sure that they lock those extremely low interest rates before they go up. And that's exactly what we are seeing. We're seeing activity accelerating. We see mortgage activity accelerating, and that will continue over the next few months. In many cases, what we are doing now, we are basically borrowing activity from the future. So if you go to the next chart, you can see what I mean by that. The market is actually not a normally functioning market. It's still very, very tight. You go to the next chart, and you can see what I mean by that. There is no inventories. So the supply issue is very, very limited. We all know the story. There is no supply. So the fundamentals of the market are very, very strong. The market slowed down over the past few months, especially in the low-rise segment of the market, not because of the fact that it's weak, but because of the fact that it's strong. It was simply operating at 70, 80,000 units a month. You have to go back to about 50, but 50 is higher than it was before the crisis, and now it will accelerate again ahead of higher interest rates. So we see activity accelerating over the next 2 to 3 months and then starting to stabilize. But a lot of other things are happening in the housing market that we have to understand and appreciate. Let's go to the next chart and see what I mean by that. First of all, this narrative of people fleeing the city. Remember the Toronto refugees, the Vancouver refugees during COVID, that everybody left Toronto, bought all kinds of houses in the suburbs. Of course, it happened because it was before the crisis, and this trend was accelerated during the crisis. However, you look at this chart, and you can see in the example of the GTA sales in Ontario, the share did not go down dramatically. You go to the next chart, and you can see that the next one, you can see that share of home sales within 300K of GTA was basically 5%. All the rest was the GTA. So what I'm saying, clearly people were trying to take advantage of working from home and get cheaper property outside Toronto. But it's 5% of sales, which means that Toronto is still the center of the universe. And if I'm right or even semi-right, this trend will slow down and might even reverse a little bit when the city totally opened up. So that's one aspect, just to put it in perspective, because I know that there was a lot of media about it. The numbers suggest that that was a marginal story, not a big story. The next chart is telling you another story. And that's something that until recently was just at the margin, but you in the profession must understand that this is happening and this is a game changer. And here I'm talking about gifting, namely parents gifting towards down payment. I just released a paper just a few weeks ago quantifying the amount. And this is very, very significant. 1/3, almost 1/3 of first-time buyers are now receiving a gift from their parents. The average gift in Canada as a whole is $80,000. Now, that's not all. Mover-uppers, 10% of them are also getting a gift. And the average is much, much higher. Just as an example, the average gift for a mover-upper in Toronto is about $260K. In Vancouver, it's about $340. That's not an insignificant amount of money. And as you can see from the next chart, that gifting is dancing to the tune of home prices. Whenever home prices slow down, gifting slows down and vice versa. COVID accelerated the process of gifting for two reasons. One, low interest rates. Parents basically told their kids, this is your chance, we will help you. Get into the market. There was this sense of urgency to get into the market. Second, as I suggested, parents were sitting on a mountain of cash, and they said maybe some of this cash can go to the kids. And also we are seeing this huge, in fact, the largest transfer of wealth in Canadian history happening. And what it happens is simply the parents of the parents, people in their 80s and 90s are now dying. They are transferring, they are in, and so the baby boomers and the parents are inheriting this money. And they are basically seeing a situation in which this money is skipping a generation and going to the kids. And that will continue because there is huge amount of money that is going to be transferred to kids. That's something that is going to happen. So this element is huge. And therefore, when you analyze the housing market in Canada, you cannot just ignore this as a marginal trend. 1/3 of first home buyers get a gift, a significant gift, and that's something that we have to consider when we look at price to income, the ability to get into the market, and the affordability issues. That's something very important to understand. And then there is another issue, which is the next chart. And that will be what will happen to the investment space in the market. We all know the story. Investors now account for what, 60-70% of new condos sales, and they account for a growing segment of the stock. So the question is it a good thing or a bad thing? How sustainable it is? So we released with Urban Nation a study just a few months ago, looking at inside the head of those investors, try to get the sense of what's happening. And we realized that about 1/3 of them are in negative cash flow. And I'm sure that many of you will not be surprised by that. And we tell them in, focus groups, why are you doing it? Are you crazy? You're losing money. And they said, no, you don't understand. first of all, somebody's paying me to finance my mortgage. That's one thing. But the most important factor and the most common answer that we got, very important to understand, is that they don't see it as a replacement for a GIC. They say, I want my son 10 years from now to have a chance to live in Toronto, Vancouver, and Toronto, or Montreal. And if I don't get into the market now, they will never have a chance. And you know what? They are absolutely right. So if you try to analyze their decision to get into the market based on cap rate and interest rates and cash flow, you are wrong. It's not about that. It's not about economics. It's about future affordability for the next generation. Very important motivation that I think is playing a significant role impacting the condo market in large cities like Toronto. And then we have the next chart, which is, okay, interest rates are rising. What does it mean? Everybody's talking about how much debt people are carrying and what happens when interest rates rise. So let's start with the future buyers. You raise interest rates by 1%. This will increase your mortgage payments on average mortgage by about $250 a month. That's not insignificant, and that will slow down the market, and that will be a good thing. But what about people that are renewing their mortgage? As you know, every 5 years, people renew the mortgage. Even if it's a variable rate mortgage, it's fixed for 5 years in terms of the term. So when you renew it, what will happen? And that's very interesting. So let's go to the last time interest rates went up, which was 2017. Let's go to the previous chart first. Sorry. Yes. And if you look at what happened in 2017, 18, when the last time interest rates went up, you can see that, yes, interest payments went up by very little, less than 0.5% of income. The effective mortgage rate went up by only 30 basis points, despite the fact that interest rates went up by much more. Why? Because everything is what happened 5 years before that. And 5 years before that, interest rates were relatively high. So any increase in interest rates in 2017, 2018 was not really impacting people because their rate was relatively high. Let's go to the current situation, which is the next chart, and we have the exactly same situation. Because remember, if you renew in the next year or two, you're comparing the new rates to the 2017, 2018 rates 5 years ago. And back then they were elevated. And I suggest that there is this buffer that interest rates can go up by 100 basis points before actually impacting anybody. So people that are going to renew their mortgage in 2022, 3, and 4 are relatively protected because interest rates 5 years earlier were relatively high. But people who took a mortgage in 2020 and 2021, and they will have to renew in 25, 26, they are exposed. And if rates remain high, they will feel the pain. But for now, for the next few years, the effectiveness of monetary policy will not be as great on people who renew their mortgage because they're already locked at a relatively high level. So that's basically where we are when it comes to the housing market. Now, let's talk about other real estate assets. The office. Of course, everybody's speculating what will happen to the office space. And the way I see it is the following. I will distinguish between class A and B in terms of real estate, office real estate. I suggest if I look at downtown Toronto, Vancouver, Montreal, and I look at big buildings, A building, and I'm saying you're a bank. What is the cost of real estate in your total revenue? It's a decimal point. What is the cost of people? 60%. So if you need to reduce real estate demand, and you probably will need because the equilibrium would be basically 3 days a week and 2 days at home. That's what I'm seeing and what the sense that I'm getting. There will be some sort of reduction in the need for real estate. However, is it worth it given where real estate is in your cost function? Maybe not, especially if you want to keep people happy and have them in a relatively large space. So I suggest that the actual reduction in demand for office space in those large buildings will not be as significant as some people expect even though less people will be working in the facility, in the office. That's A type real estate. B type, namely small office buildings, especially in the suburbs, that's where I see more damage. That's where I see vacancy rate rising. That's where I can see conversion to other things. That's where I see more of the damage that people were talking about. So that's the story regarding office. Retail. Retail is going to be challenged. But again, the dividing line will be, I believe, quality. High quality, good experience retail will do extremely well, I believe, because the experience of offline shopping will be exotic again. Low quality, low experience, that's where you're going to see vacancy rate rising. And that's a trend that started before and will continue after COVID, something to expect. Industrial, expensive for a good reason, because demand is extremely high, there's not enough supply, and you have some major buyers in the system that are not price sensitive. All this to me means that that will continue to be a sector that will generate very nice return and prices will continue to rise. So overall, to sum up, I do believe that interest rates will be rising. And the only thing that we need to do here is to make sure that interest rates go up slowly and not overnight, because overnight can plant the seeds for something bad happening after. And therefore, what we need is to see interest rates rising more slowly. It's reasonable to assume that the Bank of Canada today believes that the first move will be in April of 2022. Again, we don't know what will happen with COVID, so this is just an assumption, but I'm suggesting going slowly 3 times in 2022 as opposed to 6 or 7 times as the market is expecting will be the right thing to do. The ultimate increase will be to about 2%, but if you go slowly as opposed to overnight, I think the results will be much more positive. I will stop here and see if we have time for a discussion.
Hi, Benjamin. It was great, as always, to hear from you, and amazingly informative. Just for our listeners, we have over 250 listeners to the webinar, and they're always very well received. And the presentation here will be recorded, is being recorded, and will be posted on our YouTube channel and other social media platforms, so that you could catch it if you haven't caught all of it. So Ben, everything you said is extremely informative, and I'm taking notes now because in a year from now, we're going to do this over again.
Yeah, looking forward to it.
And we'll have to score you to see what exactly it is. But there was some very, very fascinating observations that you've made. And quite frankly, I was actually encouraged by a lot of the things that you've said. A lot of us are very nervous about the effects of COVID. There have been a few questions, and I would like to spin through a few of them. Since we have limited time, I'll just highlight some of the points that people will be making, and you could decide how you use the next 10 minutes to address them. First of all, there's a lot of stuff going on with US politics and the deficits, trillion packages here, $1 trillion packages there. How is that going to affect Canada? I'll just go through all of that, and then you'll sort of deal with everything. The other thing that the world's been focused on an extraordinary amount over the last few years was the conference in Glasgow. And there's obviously a big focus on environmental issues and how that affects us. Canada obviously did sort of a little bit of a forefront on that, but it's having a big effect on energy prices. It's having, inflationary issues. But on the other hand, we are concerned about the environment and how does that affect your views of the future. 2 other items. One is recently, City of Toronto passed inclusionary zoning bylaw. Now, everybody in the housing industry has been commenting on it, whether it's counterproductive, whether it's actually going to create affordable housing. I could tell you we're in that, Lanterra is in the business of building condominiums, but we are very concerned about affordability. But most of the cost of housing is beyond our control. The government is adding a huge amount of costs all the time. The cost of everything is getting higher, construction, land, everything. And eventually everybody's trying to figure out when that is going to come to an order. And also how, going back 10 or 15 years ago, we always sort of gauged house prices based on affordability indexes, and it doesn't seem to be correlated anymore. So tell us what you see about it.
Okay, thank you. All very good questions. So first of all, the US situation, clearly we are talking about a situation in which Biden probably will get his $1.8 or so trillion stimulus. The question is, of course, do you really want to stimulate the economy when inflation is already rising? Some Republicans and even Democrats are saying, do you really want to do it and add to inflation? That's basically the debate now, but it seems that he will get the votes. That's actually extremely important from a Canadian perspective because we will participate, I hope, in part of it. That's a discussion that we're going to see between Trudeau, the president of Mexico, and Biden. And I think we will be able to reach some agreements that would be actually beneficiary for Canada. So to us, this spending is actually a positive, directly and indirectly. In terms of the overall trade situation, I do believe that we are in the midst of a deglobalization story. We saw it starting before the crisis with Trump, and that will continue with Biden. And this is not a full-scale deglobalization, but when you wake up one morning and you realize that 90% of your antibiotics is coming from China, that's going to change. Same goes for semiconductors, same goes for many other things that are related to your industries. So I estimate that about 20% of what the US is buying from China now will come back home. And what we say home, we are trying to define home, and that's where the efforts are, as North America, as opposed to just the US. And that's more or less where we are, but we will benefit from that. Although this, of course, has some inflationary implications because prices will be higher. So that's a US situation, the environment. There are different ways of playing this game. For example, energy. One of the reasons why I think that energy prices, why energy stocks will do fine, is because energy prices are up, but investment by energy companies is basically flat. Usually when prices went up, investment went up, and therefore money would be spent. This is not happening now because they're not the future. They know that they are not the future. So they are not expanding. They're just staying where they are and collecting the money. And that's why valuations of energy stocks actually improving because the profit is well. Really accurate. What I'm saying now is that from a long-term perspective, you can achieve that, but not now. So this will lower the potential growth of the economy, and that's why we need more productivity to compensate for that. So that's the way I look at the situation. Talking about inclusionary zoning, I was asked by the city to participate in the first meeting of the inclusionary zoning, but I did not participate after. I chose not to. But I can tell you that in my opinion, although I totally understand where it's coming from, the end result will be the opposite. You will be able to get some affordable units for people, but prices will have to go up for the other units. To me, that's not a solution that is desirable. I think that the solution will have to be from the supply side, not from inclusionary zoning. I think that if they want to do that, they will have to compensate developers and provide them more incentives in terms of density in order to compensate for that. So this is not a model that, in my opinion, is the right model. It's going to hurt the system as a whole and will make affordability even worse to people that actually can afford buying a condo now. To me, that's an issue.
How do you compare Toronto, let's see, particularly Toronto prices to world prices? And is that a factor, like people looking for housing, especially immigration? You haven't spoken much about immigration. It was a big point in the last last presentation, especially when you saw the transition from Trump to Biden. And also, whenever you have house pricing going up as fast as it does, some of us who are old timers keep thinking about 1989. And that's what, everybody seems to be worried about, like this end of a cycle, comment. How do you see that?
Yeah, let me tell you something. Exactly 10 years ago, I participated in an IMF symposium in New York. The title of the debate was Short Canada, Sell Canada. Why? Because Canada is a bubble. That was 10 years ago. And it was a closed meeting, no media. There were about 30, the largest portfolio managers globally. Mr. Greenspan was there. Myron Scholes, the Nobel Prize winner in economics, was there. And I was debating somebody from New York that was suggesting that Canada will crash. That was 10 years ago. Since then, prices went up by 90%. So much for a bubble. This call for short Canada and a bubbly Canada is based on misunderstanding of the issue, which is the chronic lack of supply. This year, we are going to get 400,000 new immigrants. Next year, we're going to get 410. The year after, 420 or 425. Demand is not slowing. In fact, it's accelerating. The government, for the first time, as you know, Mark, admitting that supply is the issue. And they are willing to provide municipalities with about $3.5 billion in order to accelerate the process of releasing land and making things easier. But this money will be coming 2 or 3 years from now. So meanwhile, what the government is doing is actually encouraging demand while sitting on the supply solutions. So in the short term, it actually will stimulate demand. So this is not a bubble. This is not a crazy market. This is not a crazy market compared to major markets like New York, Manhattan, like Berlin, like London. And I believe that part of the solution, as you know, is a rental market, a very strong rental market, because I believe that we have to develop a mentality in which you are 35 years old, you are married, you have 2 kids, and you're renting, nothing is wrong with you, like in Manhattan, like in Berlin, like in London. I think that's the direction we are going, and purpose-built is part of it, and I think that's important. So no, this is not a bubble. However, with all the good fundamentals, accidents can happen. And that's why I spend about 20% of my presentation about the risk of a monetary policy error. Because again, the enemy of the market is not rising interest rates, it's rapidly rising interest rates. So we have to make sure that interest rates are not rising too rapidly to derail the market. But this is something that I believe the Bank of Canada understands. And therefore, the fundamentals of this market are extremely strong. And those people who invest in condos now, because they want their kids to have a chance to live in Toronto, they know what they're doing.
Okay, well, that's great. One last question. It's almost 2:15 and our hour is almost up. Do you see Bitcoin or other cryptocurrencies becoming part of the global fiscal, capital markets?
When it comes to Bitcoins, when it comes to the currency itself, zero interest, because it's so volatile, I don't care. But when it comes to the technology, I'm fascinated by it. I think that's the future of the financial system. However, this future will not arrive with debt. You cannot have a situation in which a bank will use Bitcoin in its asset because of the volatility. Just cannot happen. So you need a more stable environment. And the only way to achieve it is regulations. I think it's coming. I think that this space will be regulated in a very significant way, and then it will be fine for people to use as a part of the system.
Okay, so Benjamin, it's the hour is up, and I could tell you on behalf of everybody listening that it's been a great hour, very informative, and I could tell you we're batting for your predictions because it's very encouraging. It's hard to believe that we're coming on to 2 years of we're living under COVID, times that are the most dramatic times that we've ever lived through. And your guidance has helped us make sense of it, and we appreciate that. So thank you very much, and we'll see you again in a year from now.
Thank you and good luck. Bye-bye.
Bye-bye. Bye, everybody.